Consilio Wealth. Hao and I are back today to talk through a number of items that have transpired since the elections. One of those is inflation, also earnings, the newest earnings buzzword, which is tariffs, and some earnings from food companies.
Next, we have immigration.
We're going to move over to FTC and SEC leadership, crypto and M&A.
Then Social Security tax cuts. Not Social Security benefits cuts, but the tax cuts for Social Security earners.
And finally, talking through the state of financial literacy. There was a research study that was published recently that we thought we'd talk through. All right, inflation. So what's going on with inflation and what's going on with earnings? What are you hearing in earnings calls related to the change in the White House?
Yeah, well, don't get me started on egg prices, right? Like, this is what did you timestamp us? December 13th. Market closed already.
Thank you.
So, after market close, it's 1:30 Pacific. So yeah, let's talk about inflation. It's not coming down, and I think it's stuck around 2.7 for CPI core, which excludes food and energy. The Fed's goal is 2%. And again, admittedly, the Fed focuses on PCE inflation, which is what people actually spend on. But CPI, which, directionally tells us where PCE inflation is, right? Just to remind everyone, the difference is CPI is a fixed basket of goods, right? If I throw potatoes and eggs and milk in there and no one buys those, CPI still registers those price increases, right? PCE, adjusts for what people buy and don't buy. So if people aren't buying potatoes, milk, and eggs, then PCE will show a drop in demand for those goods. Does that make sense?
Mm-hmm.
Yeah.
Mm-hmm.
So when we say CPI, it's the Fed does look at it but doesn't make a decision on it. It's what people spend on, right, that they make adjustments for. So inflation came in at 2.7. Probably more concerning, yesterday the producer price index came in higher than expected or hotter than expected. And that means wholesale prices are coming up. And once you know it, eggs are up like 30%. So I know it's everyone's favorite topic, especially Chris, but eggs have been, I guess the supply of eggs has come under pressure due to the bird flu.
So crazy.
Yeah.
That story the other day I texted you. Eggs, butter, something else too. Anyway, just like, why are we doing this again?
Yeah. So eggs are not relenting. And again, I think we've argued that 100% of your salary doesn't go to eggs, but it's just something that's a core staple. That's just more of an annoyance at this point, right? For a lot of people where
Yep.
I'm paying more for eggs and I'm feeling ripped off. And that's really what the result of the election kind of is, right? We're going to punish the people who we feel are in charge and therefore the cause of high egg prices. And we're going to bring in new leadership. That's probably what the election was, just like a breakdown of, right?
Mm-hmm. Mm-hmm. So how are companies responding? And you bring up earnings buzzwords and earnings from food companies specifically.
They're already setting the groundwork for raising prices.
Okay.
And I know people do not want to hear this. I know we've talked about, political signs that Trump equals lower prices. It just won't happen if tariffs hit. Right, Trump is levying or potentially levying 60 to 100% for goods in China, and then 10 to 20% tariffs on all goods. When we published this on our doc, the very next day, Trump said he's going to levy 25% tariffs on Canadian goods and Mexican goods. Mm-hmm. So this is fluid. The market, to be fair, has not really believed what he said. The market hasn't even blinked, right? So, but the CEOs, CFOs, let's look at Lowe's right here. Brandon Sink, who's the CFO of Lowe's, said about 40% of the company's goods come from overseas, right? Including direct imports and merchandise. And that's Lowe's. You could safely assume that Home Depot's hovering around the same range because they sell the same stuff. So if they're seeing 10% tariffs, guess what prices are going to do from Home Depot and Lowe's?
Yeah,
They're
go up.
move up 10%. And then the consumer, like retailers, like the Walmart CEO has already signaled higher prices in response to any tariffs that will come down the pipe. And more cynical approach, it looks like some retailers are introducing higher prices even if tariffs don't hit.
In advance, yeah.
And that's probably the ugly side of it is similar to inflation. Oh, inflation's what percent? Someone at McDonald's is raising prices by whatever percent plus 2, right? They're always looking to get ahead of it. And yes, it does come full circle and the companies get punished on the back end of it, but we're already having to deal with higher price levels. And that's the danger of trying to get corporations to play nice because their interest is protecting their profit line and their shareholders, right?
Yeah.
And if I were a shareholder, let's say Chipotle, and the price of tortillas like go up, and they're not responding by raising prices of burritos, I'm not happy as a shareholder because they're not protecting my margins, right?
Yeah.
And that's kind of the give and take with this, where yes, we want prices to be lower, but at the same time, there's a whole slew of ownership that would get hurt by this, right?
So, but the market is saying that what was campaigned on probably won't happen as
not
extreme.
to the extremes, yes.
Yeah. And so that's, I guess my question then is the market saying, well, if Lowe's charges more money, but tariffs aren't as big as, campaigned on, is Lowe's actually making more money and therefore their profits are higher and therefore the stock goes up? Like, is that what the market's trying to say?
Up to a point.
Okay.
So it's the C-suite's job at Home Depot and Lowe's to figure out that upper limit.
Sure.
Where they're not chasing away
sales drop off.
right? Like McDonald's has. So I think that's what the market will actually anticipate and expect, right? Because I think we've seen the S&P 500 companies have grown their profit margins well beyond the highest peak of inflation.
Yeah.
And we expect that to continue. So this could be cover. This could be not as bad as it seems in the headlines.
Yeah.
I think the argument we're making is we've already seen this. We currently have tariffs, and I don't think people really blinked because they weren't quite inflationary.
Right. Yeah, 10%, right? So it didn't 10% on Chinese goods starting in 2016, I believe, and it's still in force today. So
inflation back then was what 1.8, 1.9. We were desperate to get inflation back up to 2%.
Yeah. Good point.
So, other retailers like Five Below, Crocs, Skechers.
Crocs, your favorite?
Yes, Amer Sports, American Eagle Outfitters. They're at higher risk because 20% of their sourced goods are from China, which is probably not abnormal for a retail, right, U.S. retail business. And I would venture to guess that Amazon's sourcing comes from China, at least a large part of it, right?
Yeah.
Dollar Tree is another one. And then also Yeti Holdings, they source a lot of their cups from China. So
I'm actually surprised it's only 20%. I feel like
seems low, right? It seems
low.
It should be higher.
Where's the 80% come from? I mean, I guess maybe if you're a manufacturer, maybe raw materials like leather and cotton don't come from China. Maybe it's the manufacturing that happens in China. I don't know. It's Anyway.
Well, or the not so secretive approach to tariffs is just reroute some of your trade through Singapore or through tariff-friendly countries like Vietnam and maybe Mexico.
Yeah.
All the trade routes essentially just shifted, and a lot of these companies did not pay tariffs. And I guess a more direct impact of it is if you're a CEO of an Apple, so to speak. You just, wine and dine Trump for a little bit, and then all of a sudden your products are exempt from tariffs. And you don't have to shift your supply chain.
Yeah. Okay, well, I think what I'm hearing here is this will be interesting to see play out. The market is saying what's in the media likely won't happen to that extreme nature.
Yeah.
But something's going to happen. And so, the market hasn't really priced that in. Maybe the Fed's starting to price that in terms of day after the elections, interest rates went up, inflation is stuck. And so maybe the Fed starts to hold rates more than go down by 5 more times between now and the end of next year is what they've signaled, right?
I think you've hit it. The market is already pricing in higher rates.
Yeah.
Over the next 2 years relative to what the Fed's forecasting. So the market's already ahead of the Fed.
It flipped, right? Because when
we
we're reviewing this so many times, the market was ahead of the Fed in terms of saying there's going to be more economic deterioration. You're going to have to cut faster. Yeah. And now it's the opposite. You're
going to need to cut slower.
Cut slower.
What you're expecting, yeah.
Yeah, that's pretty wild. That's pretty wild.
So in turn, that has a dual effect. The one Trump doesn't want, right? Trump does not want a stronger dollar. He wants U.S. goods to be exported out of the U.S., right, to be sold to South America, Europe, Asia.
Yeah.
If the U.S. dollar is consistently strong because our interest rates are suddenly higher than everyone else, that defeats the purpose of onshoring and then closing the gap between import-export, right? So we import $1 trillion more of goods than we export. So our trade, that's called the trade deficit. Uh-huh. We've been in a hole, and right now the hole is about $1 trillion a year. It's more of a result of how strong the U.S. dollar is, but these policies in terms of tariff, immigration, and kind of the onshoring, all that's serving to do is strengthening the dollar, which hurts our exports.
Just reading this note here on a few other at-risk companies. So Constellation Brands, which is a big beer and wine company. Diego, same thing. Liquor. Mondelez, same thing. All of these are at-risk companies because a significant amount of their business is sold in the U.S. but comes from other countries.
Yeah. Namely Mexico in those 3 names.
Mexico in those names, yeah. A little bit of Scotch from Scotland, but yeah, Mexico. Yeah, interesting.
Yeah, I read it. It says, so the line says tequila from Mexico and Scotch from Scotland. I was reading it as tequila from Scotland. I was like, why would you do that?
To sidestep the tariff. That's why you would do that. Yeah. That's why you do that. All right, let's move to immigration. What did you want to talk about here?
Yeah, I guess our most non-sticky topic here, and I'm joking, but I think immigration's just third rail. I think we got to be careful about what we talk about here, but if we stick to the economics of it and labor supply, if we stripped out all immigration, we'd have a severely shrinking population here in the U.S. And again, you can point to several countries that are hurting through this, right? Japan's one of them. They have low immigration, and they have, I believe, net shrinking population of 1% to 2% per year, which is just massive.
Yeah, that's huge.
Yeah, and their economy has shrunk since the 90s. So is that 30 years already? It's 30 years already. So a 30-year stretch of treading water, it's not our idea of something that's investable, right? Imagine investing in Japan as opposed to the U.S. over the last 30 years. You'd be hating life. I think the biggest things you could point to with the two economies, which are friendly, is the population difference. Mm-hmm. And I think that's something that we no longer care about as voters, and I think that could be a big mistake with economics and business. Again, we're looking at it from that lens, and if we ship out workers, at least workers that we know tend to be the bottom rung, the immigrant population, right? We won't have enough labor for construction, for produce, for all kinds of things that we do rely on immigrant labor for.
I think
Right.
that'll be a really interesting story to unfold as well. Again,
Yeah.
what actually happens versus what was campaigned on. We'll see.
Yeah, bigger trend. All right, let's ignore immigration for the time being. The labor force participation rate peaked in 2000 around 68%. Right, so the able-bodied worker in the U.S., 68% of us was active in the workforce.
Mm-hmm.
That's dropped down to 62%. So the demographics,
That's a big move. Wow.
yeah, and immigration had not been tight during the last 2 decades, right? So the bigger cause, I'm sure you could guess, right? What the bigger cause is of the severe drop of nearly 10% of labor force.
I mean, I'm just drawing this back. This is 62-ish% labor force participation rate brings us all the way back to the late 70s. That's a long time ago.
Yeah. Yeah, and
Wow.
I think that's cause for concern. We've talked about the gray wave for the last 10 years of my career. I think we're finally living through it. And then COVID definitely caused the gray wave to, pull in earlier retirements.
Mm-hmm.
So 62% labor force participation causes the 2002 type or 2022 type of labor tightness where a single job searcher can basically have their pick of any jobs they want,
Yeah.
which is causing wage inflation, right?
Yeah, yeah.
And I think if we don't either tighten up some of the job postings or increase labor supply or do both, we're going to probably live through another labor imbalance over the next 4 years.
Which it would push prices up.
It should, because as
in
a business
theory.
paying higher wages, you
Yeah.
got to raise your prices to.
Well, you have to pay higher wages to bring people into that job. I mean, this is coming back to the it's coming back to all the jobs that shut down, the service industry that shut down in COVID, and then that opened back up, and no one wanted to do those jobs anymore. People were going and doing other things. They were driving Ubers or whatever else. It was easier work, more flexible, and more money. And so then the wages started going up because they had just the supply and demand. It had to get more exciting to go back into that industry. And so then, now there's more of a balance, but it's far more expensive to pay those people. That's what would happen here too. So the cost of building a house goes up, cost of manufacturing a car goes up, building a plane, all the things. Even I'm speaking really in the things that we use, but even coming down to tech, the cost of building and maintaining a data center. That goes up a lot.
Yeah.
So,
If you have a data center in your neighborhood and they haven't tapped a new source of energy, your rates would have to go up on the next rate reset.
that's a whole nother deal, right?
Yeah, that's a whole
the
demand
energy
thing.
thing.
Yeah. Again, that industry is very highly regulated. So just because Microsoft moves in with a big data center, it doesn't mean your rates are going up tomorrow. But
Yeah.
probably within the next 2 years, there's going to be a big jump.
Yeah. Okay. So once again, I think we'll see how extreme this is, because at the end of the day, a lot of this sounds inflationary, but I think, the administration coming into the White House is not trying to create a ton of inflation. And so it'll be interesting to see what of all this goes through and to what degree, because to the extent that they do all of it, they probably won't do it all at 100 miles an hour. Yeah.
Correct. Yeah. Yeah.
All right, let's go over to the FTC. So likely some changes in the FTC and the SEC, and current chair Lena Khan, she's the chair of the FTC. She's been pretty aggressive in going after big companies, not a lot of tech companies so much, but some other companies and whatnot.
Yeah. Kroger and Albertsons comes to mind, right?
Yeah,
They were
that's
trying to merge. And
in the news yesterday, right?
yeah. Yeah.
I guess Google's been in the news recently too, but and it seems like I've seen the FTC launch a series of lawsuits in the last couple of weeks, just knowing that she's either going to step down or get replaced, and then those lawsuits will be open. I don't know if they have a strategy there, but it's just curious to me that I feel like every other day FTC is launching an investigation into this company. And it seems like they're doing that at an increased rate right now.
I think we agree. Chris and I have been saying that this is what we view as a pretty aggressive FTC. And I see what they're doing, but it seems to be, from the business point of view, or the business lens, it seems to be quite a bit of an overreach. And I think that is something that's celebrated by Wall Street. If Trump decides to keep Lena, I could imagine him using her aggressiveness and point it in certain directions, namely people he's just not personally friends with. But I think you can find a replacement that tries to accomplish both for him.
Probably the biggest news here that affects a lot of our clients is the Google lawsuit, being ordered to spin Chrome. And there's something else they had to spin too. But what are your thoughts on that? Does that have legs? Do you think that they're going to be forced to go through with that, or does that just die here in a couple weeks when the White
I would
House turns
imagine it dies because a lot of the lobby backing Trump seems to be more supportive of bigger business. So I don't think there's a way that the FTC pushes through with this. It doesn't make it again. I don't know if it's an overreach in this case, but Google is very large, and Chrome is one side of their business. To tell someone to sell a portion of their business, whether it's profitable or not, seems anti-capitalist, I guess. But at the same time, the FTC is there to prevent monopolies from forming, right? So, I think that I don't know enough about it, honestly, but I think it's a little odd to say you got to sell Chrome.
But that's what they did to Microsoft back in the day.
Yeah.
They told them to not bundle Internet Explorer. So that was the prescription to the problem at that time. So in a way, this feels like a page out of that book. Now, Google's using Chrome in different ways that Microsoft was using Internet Explorer, right?
Yeah.
I mean, Google's business is far different. But I thought it was interesting that they went after Chrome. I'm sure there's a lot there that I just don't know. Like, they probably get a ton of data from Chrome.
That's what I was alluding to. It's like, I don't know what was underlying the FTC's case.
Yeah.
To make that, hey, this is a formal request to use sell Chrome. Like, there had to be something there, right? I'm just saying it's weird to tell a business to sell a portion of your business.
Yeah, like that's the thing that's making you a monopoly. None of this other stuff you're doing. None of this other, it's all fine. But that one little thing over there in the corner tips it over
Exactly,
the edge.
yeah. Like, you go to a Toys R Us, you got to sell all your bikes on the rack because you're cornering all the toy market, and we don't want you to corner the bike market too.
That is kind of funny now that you say that, right?
You know what I mean?
It's almost...
there's other, internet service providers that...
Well, everybody uses Chrome, right? That's the thing. But you can use Firefox, you can use Edge,
Safari,
you can use whatever else. Yeah, Safari if you're on Mac, but Mac has such a small market share. Anyway, I think it probably has to do with data. They probably scrape a ton of data because they have basically the lion's share of the web.
Yep.
Traffic goes through Chrome, so they can get a lot of data, bring it back into their, think tank, and then create their algorithms to be more effective on search. I bet that's what it is. And if they broke that up, they would have a more difficult business, and that could then create increased competition. That's my uneducated thought on why they're going after Chrome, not like YouTube or one of these other businesses. But yeah, we'll see. And then the SEC. So Gary Gensler, he's already said he's going to step down. And the deal there is he's been quite anti-crypto. And it is thought that whoever takes his seat is going to be pro-crypto. Yeah,
it's Paul Atkins.
Already
CEO
done,
of Potomac Partners, and is pro-crypto. So
there you go.
In the surprise nomination of the year, right? So, as a result, Bitcoin, as of November 5th, is up 47%.
Yeah, pretty wild.
So, again, I could probably name one other company that's done better post-election, but I guess we'll have that conversation later. But the lobby behind, the lobby power behind Trump's nomination was very crypto-heavy. So it's really no surprise that he's making a lot of crypto-friendly regulators or heads or nominations where I'm not saying it's going to be Wild Wild West, but we were seeing quite a bit of institutionalization of Bitcoin, right? BlackRock, Fidelity had very easy access to ETFs that were cheap. In addition to the exchanges have been more, I guess, grown up relative to FTX. So I think the legitimacy of cryptocurrency, specifically Bitcoin, had been on this upward trend of maturing or growing up, right?
Yeah.
And then the election happened, and then all of a sudden it just went a whole leg up to the tune of 50% in, a month?
So what does this mean? It jumps 50% in a month, but like, where do you think this is going? What does a more crypto friendly SEC mean? What does adoption look like over the next handful of years? Like, what is all this really being priced in to say?
Yeah, I think it helps to look at Gensler's worry, which is the old SEC chair, where he assumed a lot of fraudulent activity was happening, and ultimately crypto investors would lose a lot of money as a result. I think that's always going to be a concern because crypto is still very much a volatile asset. So if you jump into it, even though we said it's been institutionalized and grown up, it still moves a lot.
Yeah.
And I think he was trying to protect, and I think that's the job of the SEC, is look out for investments that have the opportunity to create fraudulent activity and or cause real investor harm, right?
Yeah.
I don't know where the SEC was for SPACs. Again, SPACs have always been around, but the way they were deployed seemed pretty fishy. And obviously anyone invested in a SPAC has lost more than 90% of their assets. Is that a sign of a functioning trade market? Right? If people are able to extract your value and leave you with an empty bag, right? Because if you lose trust in the market due to lack of trust or viable investments, is it worth investing in anymore?
Your point is the SEC should have stepped in and said, hey, this SPAC is buying this company at an insane valuation. It's not worth that. It's ultimately going to hurt the normal people that buy those shares in pursuit of the next Google, because they don't know. So the people who are really informed are getting out at a high price, and the people who are not informed are buying, thinking it's going to keep going up, and it crashes 90%. So it's a complete wealth transfer from, frankly, poor people to rich people. That's your point. The SEC should have governed that.
Financially illiterate to the financially savvier.
Fair.
Which is our next topic. I just wanted to throw that in to get a segue, but I think Chris put it nicely where it is like, how would you know what was a really good spec? Let's go Lucid, the car manufacturer, right? The SPAC which is like a special purpose acquisition vehicle, right? And so it avoids going through public IPO, which gets scrutinized, right? And that SPAC allowed people to basically speculate on Lucid, even though, again, I'm just using hindsight, even though a luxury electric car maker probably isn't the biggest moneymaker in the planet, or probably not even a viable business.
At least they got to get a scale,
Correct, yeah.
Like,
stay private.
Well, that too.
Yeah.
Okay, interesting. Well, let's see where this goes. Once again, I think that's the theme of today's podcast. Let's see where this goes. Okay, let's move to Social Security. So,
this is a question we get a lot, though.
A lot. 3/4 of non-retired adults and 71% of adults say they worry that they won't receive their benefits from Social Security if the trust fund runs out. And this was an October survey of 2,500 people. Those worries loom larger for older Americans who are not yet retired, so they're close to retirement. This includes 81% of the working baby boomers and 82% of the Gen Xers who are worried that they may not receive their benefits at retirement age if the trust is depleted. All right. So what do we think? What are you seeing in the news? What do these worries mean? And how does it influence people's decisions?
Yeah, Social Security spending takes up about a third of the U.S. budget each year. And again, the lion's share of it is probably not the administration of it, but the actual payouts, like the pension side of it, right? I owe you, Chris, a Social Security pensioner who's retired, $1,000 a month, and multiply you by however many boomers, right, that are retiring or at the age of full retirement age. So, one, you don't have enough backfill to pay into the pool to at least sustain it in its current format. And I think that's always been the question since as long as I can remember. I remember the 80s, 90s, and 2000s and 2010s, everyone was saying Social Security is going to die. So here we are in 2024. Social Security is expected to die in 2032.
Yeah, we got like 10 years.
Yeah,
roughly.
With caveats, right?
I think it's like 2034 because it was extended because the market was up or whatever. I don't know. There was something. But yeah, let's call it 10 years.
Yeah. So if we look at it as like a pension liability, which it is, right? You have, let's say, 10 million people that need to get monthly payments. Where is that monthly payment going to come from? Well, technically, those 10 million people saved up during their working careers for that.
Yeah.
Right?
Contributed into the system, you mean?
Yeah. Yeah, it's their entitlement. How it's supposed to work is they were actually supposed to die at the age of 67. I think that's when the average age of the U.S. population was at the launch of Social Security in the, 50s? People didn't live past 70s frequently. Now we're living into the 90s. So one, the longevity is an issue. And then the people filling in behind them in terms of the workforce it's starting to look more like a cylinder. It should look more like a pyramid where you have more people paying into the system to help support the people drawing for the system.
Right.
And again, to be clear, their draw is their entitlement. Like they paid into it. Right. So for someone to see a cut is an issue, but then the sustainability side of it is an issue. But you can make adjustments to it. Trump is proposing tax cuts, right? I believe 85% of your Social Security benefits are subject to tax over a certain threshold.
Up to a max, yeah. Yep.
That tax helps fund Social Security, like it or not, right? So I think that would help speed up the process of the solvability of Social Security if you don't fix something else, whether that's increase the age of full retirement or increase the age of early retirement, right? Because Social Security is in 3 stages: early retirement, full retirement, and what's
Delayed.
that? Late retirement?
Delayed.
Delayed retirement. So you would have to just basically move all 3 brackets to get everyone to retire later, or increase the tax on the payroll side of able-bodied workers, right? I believe the cap is $168,000. So once you pay Social Security on that first $168,000, you're no longer on the hook for paying more Social Security.
Right.
So I guess that's another fix. It is a tax, but how do you support the aging population otherwise without cutting their benefits?
You know, I've long said that I think the fix to Social Security is going to be in any president in their second term, and so
who doesn't give a
because I think it's the fix is hard news, right? Benefits go down, people pay more taxes, people have to delay when they take the benefit. Like something has to happen, and I think one of those things. Maybe it's just one of those things that happens and that it actually balances out the whole program. Like, I don't think it's that extreme. I don't think that people need to start claiming at 75 in order to make the plan work. But the thing is, it's just unpopular, whatever we do. And so I think that we have potential of having maybe one more second-term president between now and when Social Security has real problems, right? So it's either going to be handled in this 4-year regime, or it's going to be in the next one if the next one goes for 8 years. That's just always been my longstanding opinion.
Yeah, the problem is there's 2 other legs of Congress, right, that are perpetually needing to get re-election.
Yeah, fair enough.
Because it is an act of Congress there because you are dealing with domestic tax policy. So if a senator is no longer wanting to, rerun, yes, but you would need 51 of them to commit political suicide. That's what Chris is saying, is to vote on this, to properly correct this, is political suicide.
That's a good point.
Right. So, again, it might seem hopeless, but I think what we're alluding to is the fixes might be a lot less painful.
Yeah.
And we've already done quite a few fixes over the last, 60 years.
Well, it'll also be like those benefits going down by, call it 25%. What would that do to economic growth? Because there's just such a huge amount of retirees that Social Security checks are their main or only source of income. And if those checks got cut by 25%, we know that 70% of GDP in the U.S. is consumer spending.
Yeah. And this leads to a Gallup poll I put on the doc here, where they were, survey of people who are expected to take Social Security and what the reality is. So the first column is Social Security as the only major source of income.
Yep.
21% expected that to be the case. In reality, it's a scary 60%, who are actually basically retired with no other assets other than Social Security. When what's that 39% gap expected to not rely on Social Security, and they end up doing so. Again, I don't know if it's like entirely their fault, but life hits you, right? You get hospitalized or lose your job prematurely, right? And I think that causes that. Right.
Man. And then the Social Security and one other source of income. Yeah, go down that line. That's actually crazy.
Yeah. This is a really crazy survey. Social Security and only one other major source of income, let's say your 401k, 34% assume that's going to be the case, and it ends up being 78% when they do retire. And then one or two major sources of income, which is actually starting to trend in the positive direction, right? Like your house or your 401k, your brokerage account, plus Social Security. Oh, but not Social Security is this third one. So one or two major sources of income, but not Social Security. 63% expect, and then 94% is reality.
Wow.
And it's just a sign of, I don't know, maybe people did properly save, but then they ended, like I mentioned, life hits them in unexpected ways. Or I think we both know what the real trend is, right? People are just severely undersaving.
Even though the savings rate's up a little bit, and but that tends to go into bank accounts. It's not like you're saving it into 401ks. I mean, again, people saving into 401ks. They're huge accounts, but Social Security is a big deal, and that's why I think you can't cut it, especially for retired people.
No,
you have to just change the way that everybody under the age of 50 pays into it or something. And it's unpopular, but it would balance it back out. I mean, you could almost make a case to reshuffle given where population growth has gone. Like they predicted population growth would go a certain way. Therefore, as you said earlier, kind of the triangle effect, the base is bigger, so you've got more people paying into the system. Well, it didn't happen, right? We had these big generations and smaller generations and big generations and so on. Well, now, since those assumptions are now off, actuarially, you would just adjust the assumptions. Very unpopular, but that's what an insurance company would do.
Yeah. So just to kind of bring it to layman's terms is like when you have an actuarial adjustment, that means either the government has to pay a bigger upfront, or the beneficiaries have to take a smaller benefit, or pay more upfront.
Yeah.
Like that's what an actuarial adjustment really means to people is
right.
Money has to come from somewhere to the square of the pie, right? Like to make the whole. So it's a nice way of saying, yes, we're living too long. We don't have enough workers behind us.
Well, to keep along with the theme, we'll just have to wait and see.
Financial literacy. So the last episode, I think a month ago at this point, right? Because things have gotten crazy schedule-wise for us. But I mentioned some guy said, "Oh, 2% inflation. Inflation is 9%. What plan are you looking at?" And I said, "This guy's financially illiterate." And I just want to take the opportunity to say that that I meant every word of it. I think people are very stupid with math and with finance, and I'm here to double down. And I think that's kind of leads from the Social Security conundrum, right? Or the speculative, like finance is such a big, broad, ugly, boring topic that you're going to run into a SPAC investment and lose your pants. You're going to have misconceptions of inflation. You're going to have misconception of credit card debt, right? You imagine, look at how wide the spectrum was. We talked about Social Security, Trump policies, tariffs, inflation, earnings calls, profit margins. How can we reasonably expect anyone to be fluent in all that? Let's say you're a doctor or engineer. Like what? You know what I mean? Like, I did mean it by that guy saying inflation's 9%, and because there's some really stupid things out there, but I just couldn't expect everyone to understand what a SPAC is.
Well, that's the beauty of the index fund, right?
Yeah.
Like buy the index fund, and I think the problem in the public world now is that an index fund is no longer an index fund. Well, an index fund is, but an ETF is no longer an index fund. Like you can ETF anything now. And so I think the public's eye is, I'll buy an ETF. That's good for me. It's low cost. Stick it to the man. But really what they're saying is they want to buy an index fund. And so there's
danger in there too, because the inverse double levered ETFs that for NVIDIA specifically.
For single stocks these days. Exactly. We did a whole episode on this.
So you'd need a financial literate approach to even that. Right, where Chris started very simple, which I totally agree with. It's become this mutated, confusing way to invest, and it could be pretty dangerous.
Are these quotes you have in here real?
Yes. So this guy Chip Layton is like a financial, not even financial. He's actually just like a life coach.
Okay.
And he gets a lot of financial questions. And these are sad. I don't know how else to say this. So here are some of the queries that he gets. What is generational wealth and why don't we have it? I have a trust
that all the time.
do I have a trust fund? I'm going to ask my mom this.
Yeah.
Do I have a trust fund? Another classic is what is my net worth, which is actually probably more in the line of what we tend to see. But I'm bringing all this up because the spectrum of financial literacy is so big and wide that I don't know if we can realistically, educate everyone on everything.
Do I need to tip the eye doctor? I mean, the answer is probably yes these days.
Is the ATM going to be open later?
When you sign out of the eye doctor, it probably asks you to leave a tip. That's probably true.
Probably nowadays. Yeah, is the ATM going to be open later?
And my mom told me the other day that when she told her teenager that she'd registered for a 401k at her new job, the response was, "How much is that in miles?"
Right.
No, come on.
Yeah. Again, are we teaching kids history? We're teaching them what a 401k is, knowing that.
Yeah, there's no finance. We did like market. We had this market thing in fourth grade. We would bring in things that we'd make at home. So it was actually pretty cool. We would
sell it to each other, right? Or trade?
And we'd sell it. Yeah, fake money, right? And it was super high. So it was like everything started at 100 or 1,000 or something. And so it was just like big money stuff, like silly money. But it got everybody, I think, in their parents' garage building something, whether it was, TY animal clothes or little bags of mini M&Ms or, whatever. And it got you to learn. Like I would sell these keychains, these circuit board keychains. So I'd get out in the garage with my dad, cut apart these old computer circuit boards, sand them down, and then we drill a hole and put a keychain in. So that's what I sold. And what I learned, and so I was in the class with somebody else, and I was called Bill, and she was called Melinda, because I was the richest person in the class at the end of the thing.
And she was your future ex-wife?
I don't know. Well, I don't know. I don't know about that. But the thing is, what I learned about her business, she sold M&Ms, and she sold a consumable. So people came back. And so she was making tons of money doing that versus me. I was selling these keychains, and I needed to expand my market because I was just selling to the class, and the class was, I don't know, 20, 25 people or whatever it is. And so after I saturated that market, my sales started to go down. And that was a problem. And so anyway, I think had we gone longer, I think she would have probably become the richest because people kept coming back to her. The same customer kept returning back.
Yeah.
So anyway, my point in saying all that is those are, I think, valuable lessons for people to learn. I don't know if people still do that in their schools or if kids are still getting taught that. But it was really great. It was really great.
Mine was in 7th grade. The teacher set up the stock market.
Okay,
and
cool.
You get to pick out of like 5 tickers. And once you know it, all 5 tickers would move up in varying degrees. And everyone was like, I want to buy more. I want to buy more.
Yeah.
Then all of a sudden the teacher turned to the board, started erasing the gains, and started writing down losses. And then everyone's like, I want to sell, I want to sell. He got to a point where he was ignoring the sell orders, and the market kept crashing and crashing and crashing. And that was our first lesson in the Great Depression, or at least the start of it. And anyone who had money left over, he's like, well, this is your bank. You could only pull out 20% of your assets.
Yeah.
And that was a ugly, fun lesson that stuck with me. It got me to study the Great Depression too.
Yeah, wow.
And I think those things, one, do you have time for that? I don't know. I really don't know in a classroom setting. And we were talking about stock market for one, but growing up, we never had credit card debt lessons or spending lessons or budgeting lessons. You know what I mean?
No.
That's what I'm saying is finance is such a broader subject that I think needs to be taught through experience, and I don't know if that's a realistic thing to teach in schools properly.
Yeah. Interesting. I don't know if they still do that. My kid's not old enough to know.
All right, and the last topic was kind of piggyback on this is Fidelity State of Wealth Mobility Study.
Okay.
Examines how Americans are faring with like wealth building, right? And the respondents with different like levels of, I guess, social status, more than half, like 56% of their parents never discuss money with them. So there's like already half the population's lost, right? Majority believe that 81% would have benefited from financial education at an earlier age. And then most Americans are changing course, saying so this is a kind of a change in the taboo topic of money, right? 4 out of 5 are saying it's important to talk to young people in their lives about the subject. And then 2/3 are currently actively engaging in the topics.
I mean, that's promising.
Yeah. So I think it's a lot of bad habits you got to undo, right? Because you and I were both raised of, we don't talk money because it's taboo. It's your business and it's my business. And
yeah. And then I get into this line of work and I just don't even think twice about asking people what they make, So it's just like at the grocery store, like, what do you make? Huh? Yeah, not really, but that's, it's just normal now.
So it's turning around. But I think the education does start from what you see from your parents. And, but it's moving fast, right? ETFs is one space where you can get really lost. How many ETFs are available to invest in?
Probably more
Thousands?
than stocks. It's probably more investment products than there are individual stocks. I'm sure there are.
Oh, yeah. How are you going to reasonably know each one? Then you got to know your personal finances, and you know what I mean? It's just, it's like never anything that is such an all-encompassing thing or topic that again, I might sound cynical, but I don't know if financial education is like the silver bullet here. I think it has to be experience.
Well, that comes back to the psychology of money.
Yeah.
I think it starts there, though. I don't know if teaching kids how to balance a checkbook is still relevant, but I think I think something along those lines to get those basics is what you need to start with.
Yeah.
Like
Again,
money
I'm
doesn't
not saying
feel
to our level, which I think was
Totally.
unrealistic. Yeah, but what level is realistic? I don't know.
money doesn't feel pulling a 20 out of your wallet and buying lunch is different than just swiping the card. So it doesn't feel.
Yeah.
You have two 20s and then
Yeah.
half is gone. And I remember feeling that, right? And now you don't think twice, you just swipe. And I can only imagine young kids that get their first card and you don't have cash. It's kind of a cashless society, and you don't feel that same. You swipe and you don't get the feeling of like, I only have half the money left now.
Yeah. You could feel your wealth dropping as you're buying
Totally, yeah.
lunch, right?
Yeah, my lunch just cut my wallet wealth in half. You don't feel that when you swipe. Yeah. And that's, I think, pretty valuable for paying cash. So, yeah. All right. Well, good conversation.
Yeah. Well, hopefully things don't turn out as bad as the media portrays. It never does. So
Never does.
But yeah, what I would say for this incoming administration relative to the Biden administration, going to be a lot more exciting, a lot more noisy.
Yeah.
Because admittedly, the Biden administration was oddly quiet and boring.
Yeah.
Which is actually good for investing. But
Yeah.
this is probably going to take a new skill set over the next 4 years.
I would agree. Yeah. I think it'll be a lot louder. A lot louder.
Yeah. Just learn to ignore more of it.
Yeah. All right, everybody. Thanks for tuning in. Happy
That was
holidays.
fun.